The retirement issue. Principles discussed in this lesson will be time value of money, individual retirement account or IRA, traditional and Roth, simplified employee pension, savings incentive match plans for employees, 401k, 403b, Roth 401k, Roth 403b, and annuities. Time value of money. There are three elements or components that affect the growth of your money: input rate, rate of return, and time. Which has the greatest potential impact? Which do you have the most control over? Starting early. Person A gets started early, setting aside $300 a month over 30 years. In that time, she will invest $108,000. Conversely, laid-back Person B keeps intending to start investing but doesn't actually get around to it until Person A has a 5-year head start. In 25 years, he will have invested $90,000. Since they're both investing for what seems like a pretty distant retirement goal, Person B figures that 5 years isn't going to make a big difference. Big mistake. Because even though he will invest only $18,000 less than Person A, $90,000 versus $108,000, the difference in return is substantial. Almost $250,000. Note: this hypothetical example excludes sales charges and expenses, and it does not represent the past or future performance of any particular investment and is used for illustrative purposes only. Rate of return cannot be guaranteed for any equity investment. Saving and retirement accounts. There are different ways for your money to work for you. A savings account is a great way to settle money or set money aside for emergencies and short-term goals. It is a liquid asset, which means it is readily available for use with no withdrawal penalty. Generally speaking, savings accounts have low interest rates, usually less than 2 or 3%, which means your input grows slowly. A retirement account offers tax advantages to encourage you to invest over the long term for a comfortable retirement. Some accounts are funded by pre-tax dollars and all have tax-deferred growth, which means the earnings on your investment are not taxed until withdrawal. Withdrawals prior to age 59 and a half usually result in tax and additional tax penalties. Hopefully, you already have a savings account for emergencies, a car, your graduation trip, or other expenses. A savings account serves a different purpose than a retirement account, which is designed to work and grow for you until you use it for living your retirement years on your terms. Traditional IRA. A traditional IRA provides tax advantages for settling aside dollars for retirement. The IRA must be set up with a custodian, which can be a bank or credit union, savings and loan association, insurance company, mutual fund, or investment broker. IRAs are offered in a variety of savings and investment vehicles, such as money market account, certificates of deposit, stocks, bonds, and mutual funds. The money going into your traditional IRA usually comes from post-tax dollars. If you have the funds deposited from your paycheck, the money is deducted from your net income after taxes have been taken from your gross income. Contributions and withdrawals. The maximum contribution limits change from year to year. The current limit is $5,000 for anyone under age 50, and folks age 50 and over can contribute an extra $1,000 per year if that person has attained age 50 by the end of the tax year. For most people, this is December 31st. Last year's tax refund, which you will receive this year, can be direct deposited into an IRA for last year. It's important to know that this does not change the April 15th deadline for IRA contributions. So, if you choose to do this, you must file your return early. You can continue to contribute to the traditional IRA as long as you have taxable income for the year in which you contributed. However, all contributions to a traditional IRA must stop once the participant reaches age 70 and a half. Withdrawals from traditional IRAs are reported and taxable. You can withdraw assets from a traditional IRA without additional tax once you have reached age 59 and a half. A withdrawal prior to age 59 and a half is called an early distribution, which may be subject to a 10% additional tax. There are certain exceptions to this general rule. Some exceptions are first-time homebuyer, disability, death of the owner, beneficiary can withdraw, unreimbursed medical expenses over a certain percentage of income, higher education expenses equal to or greater than the withdrawal, distributions prior to age 59 and a half in the form of an annuity that continues for at least 5 years or until the participant reaches age 59 and a half, whichever is later. Required minimum distribution. If you are the owner of a traditional IRA, you must start taking withdrawals from your IRA no later than April 1st of the year following the year in which you reached age 70 and a half. For example, if you turned 70 and a half in 2011, you must receive your first minimum required distribution no later than April 1st, 2012. The Pension Protection Act allows taxpayers to donate money to charities directly from their IRA account. Taxpayers are allowed to donate up to $100,000 per year from the IRA. Since the distribution will not be included in taxable income, individuals will not be able to claim a tax deduction for charitable contribution. Roth IRA. A Roth IRA provides tax advantages for setting aside dollars for retirement. The Roth must be set up with a custodian, which can be a bank, a credit union, savings and loan association, insurance company, mutual fund, or investment broker. Both IRAs are offered in a variety of savings and investment vehicles, such as money market accounts, certificates of deposits, stocks, bonds, and mutual funds. A Roth IRA is funded from post-tax dollars. The growth of a Roth IRA is tax-free. Contributions and withdrawals. The maximum contribution limits change from year to year. The current limit is $5,000 for anyone under age 50, and folks age 50 and over can contribute an extra $1,000 per year. This applies if that person has attained age 50 by the end of the tax year. For most people, this is December 31st. There are certain income limits that affect a person's specific eligibility to contribute to a Roth IRA. There are no age limitations. Unlike a traditional IRA, participants can continue to contribute to a Roth IRA past the age of 70 and a half, as long as they have taxable income for the year in which they contribute. A taxpayer's tax refund received in the following year can be direct deposited into an IRA for the prior year. It's important to know that this does not change the April 15th deadline for IRA contributions. so the tax return must be filed early. Simplified Employee Pension Plan. A simplified employee pension plan is an employer-sponsored retirement plan for small businesses and self-employed individuals. The growth is tax-deferred, and taxes are paid when the assets are withdrawn. Contributions and withdrawals. The employer makes voluntary contributions to the employee's account. Contributions can vary each year, and all eligible employees receive the same percentage of compensation. The employer making the contributions to the SEP may be eligible to deduct the amount from his or her taxes. Withdrawals from SEP IRAs are reportable and taxable. You can withdraw assets from a SEP IRA without additional tax once you have reached age 59 and a half. Simple Savings Incentive Match Plan for Employees. A simple or savings incentive match plan for employees is an employer-sponsored retirement plan that allows employees to contribute a given amount of their annual income through an income deferral plan. The rules governing them are based on the simple plan rather than on the rules for traditional Roth IRAs. The growth is tax deferred and taxes are paid when the assets are withdrawn. Contributions and withdrawals. Employees may elect to participate or not participate. Simple IRAs currently allow up to $11,500 of an employee's annual income to be contributed. The employer is required to match each participating employee's contribution up to 3% of annual compensation. Withdrawals from simple IRAs are reportable and taxable. You can withdraw assets without additional tax once you have reached age 59 and a half. 401k. A 401k is an employer-sponsored retirement plan that many companies offer their employees. Contributions and withdrawals. Usually, employees choose from a list of funds which to contribute to and how much to contribute to each fund. Employees can contribute pre-tax dollars through payroll deduction. The amount an employee contributes to the 401k from pre-tax dollars lowers taxable income. For example, if an employee is paid $1,000 but contributes $100 to a 401k, only $900 will be subject to income tax. The employer may match employee contributions up to the limit specified and/or contribute money to the employee's fund. Also, the employer may contribute to the employee's account even if the employee doesn't. Like an IRA, the invested amount and growth are not taxed until the funds are withdrawn. Withdrawals are allowed in cases of termination, death, disability, or if the company allows it upon hardship. A 20% additional tax is usually applied to any 401k dollars taken directly in cash at the time of retirement or termination. To avoid this penalty, the dollars can be directly rolled over into another tax-qualified plan. 403b. The 403b is an investment plan for employees of nonprofit organizations, hospitals, public schools, and universities. 403bs and 401ks are very similar in features and restrictions. Like the 401k plan, it was designed to enable workers to accumulate funds for retirement in long-term, income tax deferred investment accounts. Contributions and withdrawals. Usually, employees are provided a list of funds in which they may invest. From that list, employees can select which funds to contribute to and how much to contribute to each fund.